think Solvency II has overall proved a success. There are a number of important areas where improvements are needed, and I think we'll come to those later. But I think it has achieved a lot of what it set out to do. And I think it's worth taking a step back and remembering why Solvency II was introduced, and maybe also why it was not introduced. It wasn't introduced because of a particular solvency problem or a concern about consumer protection. There have always been very few failures of insurers in Europe, and even fewer where customers were impacted. And insurers have managed very well during the financial crisis in 2008 and 2013, and again have coped very well with this recent COVID crisis. Now, Solvency II was introduced because of the need to move from what was at the time a very basic framework towards one which was sophisticated, risk-based, and in line with how companies were managing risk, and doing so in a way that resulted in a harmonized approach across Europe, approach which would ensure very high levels of customer protection no matter where the customer was based in the European Union, and also would allow cross-border business within Europe and a competitive industry internationally. Now, I think these objectives really have been largely achieved, and the insurance industry remains very supportive of the Solvency II approach. And I think it's probably the most sophisticated regime in the world, and I think certainly the most conservative. And indeed, if Solvency II had been applied in the past, we would probably avoided most of those few failures that we've seen. However, there are a number of important areas where we have to prove, and I think those relate to the treatment of long-term business and the operational burden that Solvency II creates for companies. And I think we'll have a chance to discuss those later. And the current Solvency II review is basically the opportunity to address those issues. While Solvency II has generally worked well, there are some important flaws in the way Solvency II measures the insurance business, the long-term business, and the investments we make. And those do create real barriers. And the issues arise because currently Solvency II overestimates the liabilities, creates too much volatility in the balance sheet, and also overestimates the investment of long-term risk. So these are all related to our long-term business model. And this is key because it's our long-term business model and the fact that we write and sell long-term products that allows us to invest in a long-term way and to avoid the market volatility and forced selling situations that other investors can be exposed to. And that, of course, allows us to play a key role in the economy. And now, during the need for recovery and growth, we can play a key role if these issues are addressed. Now, maybe just touching very quickly on some of those issues. So I think, so in terms of the liabilities, the key issue there is the risk margin, which is far too high. It currently takes away 160 billion off our balance sheet, which is a reduction in our risk capacity to invest and underwrite. And there are a number of technical reasons why, justifications for why that can be reduced. We also have the volatility adjustment, and this was a really key tool which was included to try to capture the interaction between assets and liabilities. And without it, Solvency II really wouldn't have worked at all. But it doesn't work well enough. It still allows too much volatility into the system, leading to artificial volatility, and it also is set too low. So these are two key improvement areas where we need improvements. In terms of the measurement of risk, we also need to recognize that when insurers invest in assets, they're exposed to the long-term underperformance and not the short-term market volatility. So there's another area where we need improvements in terms of the calibration of the asset risk. One area which is often talked about is interest rates, and it's important to recognize there's two elements to interest rates. One is the way in which the risk-free curves are set, and those are used for the valuation. And here we really think there's no need for a change. There are a number of mechanisms that ensure that insurers are already holding in more than enough reserves to protect customers. The other element of interest rate risk is the risk that interest rates go lower. And this is covered by the capital charge for interest rate risk. And here there is a change that is justified, because currently Solvency II doesn't recognize or allow for negative interest rates. So this is one area that does need to be changed, and this will result in an increase in capital. But the other changes would result in decreases, which should more than offset this increase from recognizing negative interest rates. I really think that the two main objectives that the Commission should bear in mind when considering what changes to make in this review really do focus around addressing the long-term issue and making sure that the industry can play their full role in investments and long-term products. But I think there's another important area that I mentioned earlier on, and that relates to the operational burden. Solvency II, I think Solvency I and all the related directives amounted to 199 pages. Solvency II and all the level 2 and 3 adds up to over 3,500 pages. So it's a really huge framework. And now a lot of that is needed because we need a sophisticated regime, but we also need proportionality to work. And proportionality was a key concept which was included in Solvency II, and indeed I think all European regulation, to make sure that it really can work in practice. And this means that small companies can apply simpler and simple companies with low risk can apply estimates and simplifications. But even larger companies where they have minimal exposures and non-material elements to their balance sheets and their risks, they should also be able to apply proportionality. And unfortunately, while it's a very good principle, it doesn't actually work in practice. It's very rarely applied, either because the supervisors don't allow it or because the companies have to do too much to justify it, and it's just not worth it. So that's another area where the Commission, I think, really needs to look. Beyond that, I think there are a few other areas that are worth considering. I think one is on systemic risk. Insurers are not systemic by nature, but there is a need to make sure that the systemic situation is monitored. And a number of elements such as recovery plans, liquidity reporting, there is some merit in looking into those. But again, in a proportionate way where they're really needed, not in an excessive way. And I think the final element where there is a need for changes is on cross-border activity. Here, EIOPA has actually proposed some changes which would increase their effectiveness in ensuring supervisors coordinate and cooperate on cross-border issues. And that's one final area where I think the review could make some changes.